All right. It's Friday. Let's do this. We're going to be talking about raising capital for a real estate deal. It's something I know a lot about. We've probably raised over $100 million of high net worth capital. We've raised institutional capital. And I'm going to basically share everything that I've learned, that I know with you. If you are thinking about raising capital for a real estate deal, before we jump in, what we're going to do is I want to talk to you about DoveHill. We own and operate hospitality projects. We do some industrial, and this is not about investing in our deals. We are raising capital for a preferred equity deal that we're doing in Savannah, Georgia right now. It is an awesome deal. We're about halfway through the capitalization. And I thought what would be really fun is if I used the approach we're taking on that deal to raise capital and used the deck to raise capital for that deal to talk about how we raise capital. And if you are interested in investing and you are an accredited investor, then you should go here to dovehillcos.com, click on invest. You can fill out all the information here. We will verify that you're accredited. The minimum investment on that deal is $150,000. So if you're serious, if you're interested in that deal, great. You can look there, but this call is not for raising capital there. And that is not my goal. My goal is to help all of you raise some capital and knock it out of the park. So the other thing that I wanted to mention is that I've got this little podcast, Masters of Moments. So many of my friends have come on the podcast. It's been amazing. We have over 100 episodes. We talk to some brilliant people in real estate, hospitality, investing, and company building about how they did it. And I've learned so much from the podcast. I know that a lot of other people have too. It's broadened my network. It's introduced me to some of you on the call. And I would really love it if you check out the podcast, give it a little review. That would be awesome. Give me 5 stars. And please enjoy. It's like free learning. I do it because I love it. And selfishly, I learn a lot too. My first deal was in 2011. And when I started in the business, my dad had 3 hotels and he basically had one family as his partner. And when I came into the business, I didn't want to be partners with that family. I wanted to grow the company much bigger, and I wanted to do it in a very different way. I wanted to do it in the style of private equity. My kind of role model mentor, I didn't know him at the time, but Barry Sternlicht. I wanted to model my company, my approach after him and other great real estate investors like Dean Adler of Lupert Adler, who we've now had the pleasure of doing a lot of deals with. And I've learned so much from, but it was very different from what my dad was doing. So I had this idea that I wanted to raise a hospitality fund. I literally graduated law school. I had no track record. I had no experience other than working for a lot of smart people, you know, from Hersha Hospitality Trust to Brad Korsnick Core, which is now like Proper, and my own company with my dad, but I had no track record. Like my track record was like my dad managed 3 hotels locally, regionally in Philadelphia. And I thought I was going to go out and raise a $30 million fund. And everyone I went to said no. They said, no, we love you. You're such a nice kid, but we're not just going to give you $30 million. We don't have $30 million anyways, but we're not just going to give you a few $1,000,000 to go out and pick whatever deals you want. We want to see the deal. So that was a huge eye-opening moment for me. And one of the things that I realized is it's a lot easier to raise money for a single investment than it is for a fund. So if you are a first-time real estate entrepreneur and you are looking to take other people's money to invest in real estate, I would recommend doing that on a deal-by-deal basis first. Now, if you've worked at Blackstone for 20 years and you know all these big institutional investors, sure, maybe you can go out and raise a fund. But if you don't have that experience or pedigree, it's oftentimes easier to raise capital on a single deal. And that's what I did. I found a deal, and it was a deal where I guess you would call it a co-GP deal. It was a parking lot owner that was a very sophisticated developer in Philadelphia, and they couldn't get their hotel built because they couldn't get the financing, because banks always want a strategic hospitality partner at the table because they need an expert in the room in hotels because they're such a complicated business. So I came into the deal. I knew these people. They knew my dad and his business. So they reached out and they said, "Can you be helpful?" And I said, "Yeah, sure. We'll put in half of the equity. We'll put in $7 million. I had no fucking clue how to raise this equity. I didn't have $7 million. My dad didn't have $7 million. We were not putting in $7 million in this deal, but I committed to these nice people who were unbelievable. That was basically a shovel-ready project that we would put in $7 million. So what did I do? I went back to all those people that said, "I don't want to invest in a fund, I'll invest in a deal." And I went and talked to them. And I spoke to every single person that I knew. And then I would ask those people if they knew anyone that wanted to invest. And I scratched and clawed, and I somehow raised $2.5 million. Well, I needed $7 million. So I was kind of fucked, I guess, because I have $2.5 million, but I needed $7 million. So I went back to the partner and I said, "Listen, like, we're still raising money. We still want to do the deal. You need us, but we don't have all the money right now." So we basically were able to close on the construction loan, and we were able to start. Even though I didn't have all the money, they said, "We know you're good for it. We know you're going to figure it out. Just keep grinding away." And how it works in a typical deal like that is the bank wants you to use the equity first, and then you're going to draw on the bank's money. So sometimes, even if you don't have all the equity, and now this is risky, I'm not really advocating this, but you can close on the deal because the bank knows that you got to fund the equity first. So that's really what we did. And perhaps these guys maybe had some sort of a backup plan. I didn't know about it. But then I started talking to like smaller private equity firms, like really small private equity firms. And I found one that wanted to do the deal. And they also wanted certain rights. They wanted like certain fees out of the deal. So it was great. But like I couldn't jam them in on my side because I can't like hide this private equity firm under me and not tell my partner. So I had to go back to my partner. And I went back to my partner and I said, "Hey, I found the money, but they're going to want certain rights. They're going to want to be recognized. They're going to want certain major decisions. Let's bring them into the deal. They're good people. Why don't you meet them?" So they met them. And as part of that process, I basically said, this was kind of my side of the deal. I was going to get the promote, the carried interest, my share of their profits. I was going to take 100% of it. But because you've been so accommodating to me, I'm going to split it and we'll take 50-50. Well, fast forward like 7 years, the deal was a phenomenal success. It was one of the best deals we ever did. And we made a lot of money. The promote was huge. Even though we split 50% of it with our great partner, the promote was big. The private equity firm made a lot of money. And that experience taught me a couple things. It taught me that raising capital is really hard. And don't let anyone tell you that it's easy. It taught me that you have to be humble, taught me that you have to treat investors fairly and with respect. And it also taught me the importance of kind of having an abundance mindset. And there's a lot of people that you'll find in real estate where it's just a zero-sum game, meaning like they have to win and you have to lose. I think everyone can win and there's a big enough pie for everybody. And I really believe in a lot of deals, if there's room that you can share certain things, and maybe by doing that, by partnering with someone, that might open up other opportunities for you. And you might lose a little bit on this deal, but it opens up the world of possibilities for you. It's like the analogy, do you want 100% of a grape or 10% of a watermelon? And that has really stuck with me through a lot of my career because, when you start doing bigger and bigger deals, and you deal with institutional private equity firms, sometimes they have a lot of leverage over you. Sometimes they don't, but sometimes they do. And when you're negotiating your fees and your promote and how it all works, I always think in the back of my head, can I do repeat deals with this person, with this group? And what is the opportunity set? Let me tell you the worst thing that's going to happen. The worst thing that's going to happen is you have a crappy deal with them. They're complete assholes. They're complete jerks. And you just do one deal with them. That's it. And you move on. But what if they're amazing and they have a great pipeline and they always want to fund your deals and they want to do more deals with you and they support you? And maybe over time, your deal kind of changes. I think the upside is far more superior than the downside. And that's always how I look at it. That's kind of how I look at the world. Maybe I'll get screwed once in a while, but I think more times than not, good things will come our way. So that was the first time I ever raised capital. I actually still have that memo and that pitch deck today. And a couple of the things I learned also on that experience is you don't want to overpromise and underdeliver. So it's always best to be a little bit conservative in your underwriting and what you're telling investors. And you never, ever want to guarantee anything to investors. You don't know what's going to happen. Do not guarantee anything. Say, this is what I think. This is what I expect. This is what we underwrote. Don't say, I guarantee you a 10% return, because you can't guarantee shit. Like, unless you're doing the deal with the government and they're going to 100% pay you and you're definitely not doing the deal. So that means you can't guarantee anything. So don't guarantee anything. Say, I expect, this is what we're underwriting, this is what we're targeting. And if something bad comes up, let people know. Be honest, be open. And those were some key takeaways from the first deal. The other learning I had from the first deal in terms of dealing with investors is that oftentimes investors invest in groups. Okay. So you might get into a group of doctors. You might get into a group of former commodities traders, and they like to share deals amongst each other. So it's totally fine. And I encourage you to ask someone that commits to your deal if they know other people that might be interested in investing in the same opportunity, or do they have other people that they oftentimes invest with that you could share the deal with? You don't need to necessarily compensate them, and you should look up compensation rules because there's very specific rules about that the SEC governs. But people are often willing to share their deal flow with their friends because their friends share their deal flow with them. And that could be a big positive thing, and that would open the door up to a lot of investors. One question I get often is, if you're raising money deal by deal, there's so much time pressure to raise all the capital in a short amount of time when you have to get the deal done. That means you need to be doing capital raising before you have a deal. How do you do that? You basically capital raise with the idea of a deal. Talk to anyone in your network that has money. Talk to anyone in your network whose family has money. Talk to business people. Talk to people at the tennis court. Talk to people at the golf course. Talk to people and tell them what you are doing. Tell them about the strategy. Tell them about the opportunity. So when you do have the opportunity, you can go to them and it better align. Like if you're investing in hotels or micro resorts, talk to people about that opportunity set and why it's so interesting, but then don't take them like a random self-storage deal. You're gonna lose all credibility. Take them something that fits the parameters that you've been outlining, but you have to build up this rapport. And one of the mistakes I made was not having like a detailed database and really keeping track of investors. Like I was doing it on Excel. Now there are so many different tools. We use Juniper Square, but there's you can even simplify it. I'm sure you guys have some great ideas, and we can talk about it, of ways to keep track of your investor database and how to communicate with people in the form of a CRM, and to take detailed notes about those conversations, about what people said. Maybe someone's saying they can't invest now, but they're having a liquidity event in the future and they can invest then. You want to kind of know about those things to be able to come back to people. And then when you have a deal, you want to easily communicate with them the CRM, through the CRM. So let's jump into some of the tools we use to raise capital, and I'll start with the deal that we're doing right now. So this is a preferred equity deal in Savannah. Don't worry, I've blocked out some of the stuff so you can't see exactly what the deal is. But if you kind of want to invest in the deal, you can, get the information from us, but please don't just ask for it just because you want it. Like, you got to really be committed. So let me share my screen. So here's kind of the first thing we do. The first thing we do is we make like an internal memo. And I think it's very important for everyone to get in the habit to articulate the ideas about why you think this is a viable investment. And for us, we like to write that down in kind of a very wordy memo format. And this serves a few purposes. One, if you do have a company, it gives everyone something to talk about at the table to decide if you want to proceed, if you want to do the deal. So maybe you have a couple partners, maybe, you each kind of pursue your own deals. This is a great way to bring it to a table and to discuss it. The second thing is, now that you've written this memo, you can then take pieces of it to create other forms of collateral that you're going to then use to raise capital. Third, if you are raising capital maybe from a single investor because it's a very wealthy person or an institution, you can send this document as like a teaser. Hey, we're still working on the full deck, but we've got a little teaser for you, just kind of get you up to speed on the opportunity. So here is what it looks like. Okay. It's, we do this in Canva. Okay. We use Canva, which is so awesome because I had to use like PowerPoint and like Apple Pages and like all this weird stuff back in the day. But now you have so many different ways to create these, but we use Canva and we kind of have a format. We stick to the format so we don't reinvent the wheel. So the first thing that I always like to do is go through an investment overview. What the hell is the investment? I don't know how many decks that people send me where it's like the most beautiful pictures, the most beautiful design of a deck. It's 10,000 pages and I'm in the first 2 or 3 pages and I don't know what it is. What's the opportunity? I don't know what it is. Is it like a photography company? Are you creating a magazine? I don't know. Like, how many decks have I seen that like there's like 20 pages of beautiful pictures before you even know what the hell it is? We tell you what it is right here. The first thing you can read is exactly what the opportunity is. DoveHill has the opportunity to provide $6 million of preferred equity for the redevelopment of the blank in an existing 16-key property to 22 keys, plus the construction of a new 42-key wing, which will be the 4-star hotel in a great location in Savannah. Then I go into a little bit more detail, okay? This is off market. There are some key words. You want to tie these key words that are going to be your competitive advantages in this first paragraph, okay? And then we give some cost information. We say how we're going to use the money. And this is a preferred equity deal. So preferred equity deal, for those that don't know, it's like supercharged equity. We are getting overpaid to take debt-like risk and earn equity-like returns. We sit behind the debt, but in front of all the common equity, which means we get paid first before the common equity sees anything. And for that, we give up a little bit of upside, but we are protecting ourselves significantly relative to the common from a risk standpoint. So here I lay out some of the key terms of the pref, because that's like really key part of the deal. It's like a structuring thing. It's not like a ground up development of something where you might go into something else in this section. Then we have this section. It's called Why We Like It. This is probably the most important part of any of the collateral that we create. Why do you like the deal? Tell people why you like the deal, and you better explain how it's great, why it's great, what's so great about it, what your edge is. You need to articulate that. If you can't articulate it, you're not going to be able to raise capital. So here are the, I don't know, what are there, 7, 8 reasons why we like the deal. And we always like have keywords. So you can kind of like always remember the keywords, right? So, shovel ready, experience sponsorship, limited new supply, diversity of demand, location, huge. Last dollar basis, it's great. Deal structure. Actually, Frankly, deal structure should probably be at the top, but we just talked about it here. So I kind of like lumped it at the bottom. Okay. So now by this point, whether it's internal or you're using it for other people, everyone knows what's going on. Everyone knows what the deal is. Now you can tell them a little bit more about the deal. We're going into the market. We're going into the background of the sponsors because, we're not the sponsors. Here's the profile on everybody. Here's some market intel. Investors want you to know everything. If you are investing in a deal, you've got to go around and get market intel. One of the best ways, and this is like a trade secret, one of the best ways that I found out to get market intel is get it from people that are there on the ground. Maybe you're there on the ground, but maybe they're doing the same thing you're doing. They might have a different perspective. Ask people. But you might say, well, if I ask them about the deal, they know I'm pursuing it. They might try and interfere. Yes, that's all true. But you have to find people that maybe you can trust a little bit that won't screw you. And if someone screws you, then you'll know never to talk to them again and you could write them off forever. But in my experience, more times than not, people will generally be helpful or they will kind of be polite, but not helpful, but they won't screw you. There's a few cases where they'll like full on screw you. And, you don't want to be that person. And, you'll never have to associate with them again. Even for like these deal, we called some people and they weren't that forthcoming with information because maybe they were working on similar things. That's okay. Then call another person, but go get information from other people in the market. Maybe that's a broker, maybe that's a contractor, maybe that's a manager of a hotel. And what's really cool is you can list that in your deck. I wouldn't list it in this because it's too small, but take notes and list it in your deck so that people know and you can always kind of refer back to it. Then obviously we put in a pro forma, and this is a hotel. So this is really like a hotel pro forma, different from a cash flow. So in a cash flow, you're going to see debt service, you're going to see maybe some owner real estate expenses, and then you're going to see the investor net cash flow. This is just the pro forma. We have some photos, we have some renderings of again, this is the preferred equity deal that we're doing in Savannah. We have a map. Here's the cash flow. Now we're going into the cash flow. This is really, really important. We often do it on an unlevered basis and a levered basis because different investors like looking at different metrics. So what we'll do is we'll summarize some of the key KPIs, okay, up top. We won't take everything from the pro forma. And then we'll figure out the cash flow. Here, there's no debt. So it's pretty much just the profitability of the asset. Now here's the levered cash flow, and we're showing the returns to pref equity. The reason why pref equity is so great in this deal, we sweep 100% of the cash. We're not even sharing any of the cash flow until we get our minimum return. So here we show the senior loan, and then it goes into the pref equity cash flows. And then right here is what we think the deal is going to return. So with preferred equity, we have a minimum multiple that, yes, it's guaranteed. Doesn't mean we're going to hit it, but the common equity sponsor has to pay it. If they don't, that means they're getting nothing. So that matches our expectations for the deal, that matches what we agreed to. And we show that right there. Boom. And that's it. This is our internal memo. Okay. So then what we do is we take that, we make a long form memo. One of the things when we're making the long form memo that we like to do is we put the returns and the hold period right on the front. And everyone's investing to make a profit. Well, we show you what it is up front. Now, it's very important to disclose the net return to the investor versus the gross. The gross would be before maybe your asset management fees and before your promoter carry. Net is what they take home. So you should always specify what it is. Here we say returns to the investor net of any and all partnership allocations. Boom. So this is what the investor is going to take home. Wow, these are great returns. Pref equity, gotta love it. So in the long form memo, we always have like within the second page, again, what is the deal? Boom, we give people all the key information right here. Here's the key information, everything. Then second page, again, why we like it. This is the most important page of the entire deck because it articulates to your capital why you like the deal and why they will like the deal. One thing I don't think sponsors do enough is articulate clearly what their competitive edge is. What separates you from the other guy coming 30 minutes after to pitch another deal? Okay. Maybe both deals are a very, very similar structure. What is your competitive edge? You have to be able to articulate why you are well suited for the deal. It could be experience. It could be knowledge of the market. It could be like that you sourced it off market. That was a competitive edge for us here. It could be your experience structuring and doing deals like this. We, in our case, are a strategic partner. We invest in preferred equity because we're experts in hotels and we invest in our own hotels and we could be a real additive to the deal. Another competitive edge, we are seeing deals that the big institutional private equity firms are not seeing because the deal size is below their radar. So, Mr. Investor, I'm showing you a deal that if you invested with, I don't know, Carlisle, you're not going to see because it's too small for them. And here's the thing that I'm sure you guys know. The smaller deals often have the bigger returns because they're the ones that are potentially a little bit less sophisticated. They're less bid up, less people look at them. Doesn't mean you can work on all small deals because then you'll never get scale, but it's just an interesting edge. Again, this is a preferred equity deal. So it's important for us to spend time talking about the deal structure. But if you're not doing a preferred equity deal, then you might not have this deal structure page and you might have something else. That's very important. But for us, this is a preferred equity deal. So it's almost in a way like almost more important than the real estate. It's like the structure. We're investing in like a financial instrument. It's collateralized by the real estate. You got to like the real estate, but the structure is really important. So we talk about that. We summarize some more highlights. Okay. You guys love this. We got it. Boom. Then we start talking about ourselves. Here's our experience. Here's how many hotels we have. Here's where we're located. Then we're going into the property. We're giving the location, some exterior renderings, interior renderings. We're talking about our partners, what they've done. Again, this is preferred equity. It's very important that they have that knowledge. We talk about food and beverage. In this instance, food and beverage is a big component here. We're leasing that out. Go into a bit more detailed information about the location, break up the market. And by the way, there is no, how cool is AI? Is AI not the coolest thing? And now they have deep research. I think Grok is really great, but we also use ChatGPT. I mean, there's so much stuff and you have to verify it that you can get. You don't want to bombard people though with too much information. Like literally, in addition to those like decks with all the pictures where I don't even know what the investment is until halfway through or sometimes ever, those decks also have so much words. Like, who wants to read all those words? They're just too many words. You have to condense and summarize the key takeaways. If you want to follow up with additional information, then people can do that. If you want to send people additional information, people can do that. If you want to have an appendix, have an appendix, but don't load up your deck. No one is going to spend hours and hours reading your deck. Do not send out a 60-page deck. I'll go into like one of the real secrets that we do in a second. It was a little bit longer than it should have been, but it worked. Be respectful of your investors' time. Boil down the most important parts, okay? Got to get into the financials. We always close with the financials, but boom, right here is like the most simplest view of the financials. And again, these are gross returns. This is what we show. Boom. Sources and uses. We break down where the money's coming from, how it's being used. Very clear, easy to understand. Projected investor returns. I'm going to stay here. Do not copy and paste what's in your model into your deck. You need to design it up a little bit. Okay. So what we do is we have our model, and then within our model, we have like pretty pages that get inserted into the deck. This would be an example of a pretty page. So this little square is in Excel. It's linked to the different areas in our model, and it looks pretty, and we can put it right into the deck. This deck we made in Canva, by the way. So the important thing and reason you do that is because if you ever have to make updates and update your deck, it's always easy to suck things out of the model if you're making changes in the model and put them into your deck. And I'm sure there's like really smart, creative people on here that can do it a lot faster than we can by some kind of, Zapier thing or who knows, but definitely it has to be pretty. It has to be simple. Like, investors don't need to know like all the 50 lines in your initial deck. They can look at that in the appendix, or you can send them your model later on. Just show them what they want to know and break down the waterfall. Everyone here is in it to make money. So if you're not going to raise capital, you're probably not on this call. But if you're raising capital from other people, then you're likely going to get paid what's called a promote if the deal is successful, or carried interest. It's the investor's share of the profits that you're going to take as the sponsor. Okay. So we can talk about different ways to do waterfalls, and maybe there'll be some questions around that. I'm happy to go into it. I've done very complicated waterfalls. I've done very simple waterfalls. For the past couple of deals we've been on, I'm on the simple waterfall phase, which is like one hurdle. So it's like the investor gets their money back, maybe a little priority return, and then we split it. Or the investor gets their money back, and then we just split it. Keep it very simple. And when you do that, you might leave money on the table, but you're building loyalty with your investors because it's a simple methodology. They can articulate it to their friends. They can articulate it to their kids who might inherit this investment. It's simple, and I like it. And depending on the deal, we might change it slightly based on the risk or based on different factors, but we often try and keep it simple. If we're doing a deal with an institution, private equity firm, then we're probably going to have multi-tiers because they're complicated. I'm complicated. I can be as complicated as they can be. Let's go and let's both make money together, and I'll probably make more money on that deal. But again, I like it for the high net worth guys and family offices. Just keep it simple. So here we go into some sales comps. Very, very important to justify kind of your price, your returns, your exit, all that. And then I like to, again, remind people why we like it. So I just copy and paste this thing, put it at the end, boom. They got to know who to call if you're going to raise money. So put your name, put your picture, put your cell phone, put your email. If you have someone else that they're going to talk to too, in this case, we have Charles, he's our CIO. He deals with investors as well, and he's great. So we introduce him to our investors. So that's the deck. We are going to go into one of the biggest things that I discovered in the past couple of years, and is a very, very effective tool to raising capital. So this is an email. Remember I said you have to develop that database of all the investors? And like after your first deal, obviously those investors go into the database. You ask them for their friends, maybe they'll go in, whether they invest or not. You want to like characterize them. Again, we use Juniper Square. Juniper Square is awesome. Like, they're not a sponsor of the podcast, but it's a good platform. So I always tell people that. So this is the email that I send investors introducing an investment opportunity. Okay. This is really hard because an investor has to open this email. They have to read all this shit, and you have to hope that they click the link. Click the link to what? So you have to have a good subject. Okay. You have to make sure it doesn't go to spam. And you kind of really need to get right to the meat of it very quickly. And if they're interested, they'll keep reading. If they're not, they'll hit delete. Okay. So right away, I'm hitting you with what the deal is, what the returns are, what the structure is. But you'll see all these blue links around here. So a lot of blue links, blue links, blue links, blue links. I was on the phone with a potential investor today, and he said, I almost didn't watch your video. And you're going to ask what video, but I'll talk about it in a second. But you kept pointing me to these links. There's like 3 or 4 things, and I felt like I had to click it. It's very important, I think. We'll talk about what I'm going to show you next. but you got to get people to click this link. You got to get them to click the link. Do not just have one link at the end. Get them to click the link and put it in a few places. And what I often like to do is attach to the email a teaser memo, because some people do like to read and they want to see it, but don't attach the long memo. Let that be for the follow-up. Just attach the teaser memo. Okay, what is Jake talking about with these links? I don't know what he's talking about. Oh, okay. This is the biggest secret, okay? I record myself walking investors through the deck. It is so much more engaging, so much more personal when you have the opportunity to film a video of yourself walking investors through your investment deck. And you've got to make it like short and sweet. So I always say, hey, I'm going to go through things quickly. I may gloss over something, but you can always pause, slow it down, speed up, or reach out if you have a question. But you get to walk someone through the deck and explain to them in your own words, with your face, with your picture, talking, showcasing the deal. It's awesome. People like it. But my recommendation would be to try and keep it to 12 minutes. I didn't do that on this one, and I always do it. But on this one, I didn't do it. The reason why I didn't do it is because I didn't have a script. I went kind of off cuff. I just went with it because I was so pumped up about this deal. I know everything. I don't need to read a script. I just want to go. And this one was like 25 minutes. It's a little long. Now they can speed it up like to 1-2, like see, you could put it on 1-2 and then it's going to be a little bit shorter. The cool thing about this is like they can also click around to these different parts. So I made this one in Canva. Actually, you can record it directly in Canva, which is really cool. And another thing I like to do is I like to write out a script so that I can kind of stick to the timeline. Here, again, I didn't have a script, so I just kind of went with it. It felt more natural. Like, I don't know, I go both ways, but make sure you keep it as close as possible, 12, 15 minutes. That way they can speed it up maybe to like 10 minutes and you're just home run. So obviously it goes without saying, if you're making a video of yourself, make sure you have good lighting, make sure you're looking into the camera, make sure you're dressed professionally, make sure you look presentable, pretend you're there in person and practice it. So Charles on my team, I filmed this, okay? And these take a lot, like it is hardcore, okay? Charles on my team was like, I sent it to him, he's like, you weren't that energized. I didn't really like this one. I'm like, fuck, like, are you kidding me? Like, I just sat here for 45 minutes, like doing takes and recording this thing, and you're telling me it's like not that great? I was annoyed. He's like, you're always better in the morning. Do it in the morning. I'm like, I just did it. I'm not doing it again. I did it again. It was better. So make sure if you know you're good in the morning, if you know you're good in the afternoon, make sure you're good and do it and make sure you get it right, because this is like computer software. You can send this thing out 100 times. So make sure it's good and you don't have to keep redoing it. The benefit of filming these videos is that when you go to meet the investor in person or you go to talk to the investor on the phone, they already know about the deal. You don't have to explain the deal to them. So now, then they are getting into the specifics of the deal. They're getting into the questions. You're getting to the meat of it. Like the ice is already broken. It's a great icebreaker. It's also my experience that we just raise capital, okay, from the video. Like whether they're a new investor or an existing investor, people just watch the video. They say, hey, this is an interesting deal. These people look compelling. Let me look them up. And we have a link and they could just sign up for their commitment through a website. And that happens a lot too. So you can actually like raise capital without having to like physically be there. It's unbelievable. That is a huge secret. That's been a huge takeaway for us. I would encourage you to do it. I would encourage you to have someone else watch it after you do it to make sure it doesn't suck. But you have to have a deck in order to do it. And then sometimes we'll do like a condensed deck for the video, and then we'll have like a longer one if they request it. And then they can always request, they're like, hey, I want to look at the deck. Like I want to like page through it. You can always email it to them. And what we have in our deck in the longer version, we often have an appendix, which with like additional information that I wouldn't go through on the video. I'm not going to go through the appendix on the video. Those are like, if the person wants to double click, they can do that on their own. They can ask me questions and they can follow up. That is the majority of what I wanted to talk about. I guess the one thing I'll end with, if you're a real investor and you like this pref equity deal, great, you can sign up and do it. But kind of the intake for us is very important. You want to track people and you want to have a very clear understanding of who's investing in the deal. So this is just the intake form on our website. If you're an accredited investor, you can fill it out. And then if we have a live deal, our team will review your accreditation and send it in. Okay. This one has 150,000 minimum. Once we send you the deal though, there will be a link in that email to actually like commit to the deal. And this is a commitment so that it goes into our system. We're tracking it. And ideally you should have all of your investment docs ready. So all of our investments are pretty much Reg D 506C. I'm not going to talk about that stuff. ChatGPT, the difference between Reg D 506C and Reg D 506B. There's like a 506A, I think, as well. It's just who you can solicit, who you can raise capital from, because you are essentially selling a security in something. If you're selling a security, you have to notify the SEC, and this is an unregistered security offering, but you have to do an SEC filing. So make sure you do all that stuff. But we do that. So 506C is how we're raising capital for that deal. So once someone selects it, they say they're going to commit, we then have the ability to send them documents and they can sign up. The documents that we send them is the operating agreement. They can read that. The PPM, and that has like a bunch of risk factors. It has like a bunch of written explanations on the deal, the structure, the investment, the different documents involved. We'll have a copy of the operating agreement, and then we have a subscription agreement. The subscription agreement is basically you as an investor or an entity signing in to be a member of the entity that we've formed to make the investment. And it's a contract that you're signing saying you are going to contribute X amount of dollars to the deal, and we can rely on you to do that. And what I would recommend is you call capital as soon as possible. You want to get the capital in. You don't want to have people flake out on your deal the week you're trying to close. So you want to really have your capital in a few weeks before you're actually going to close on the deal. So you make sure you have all your ducks in a row. The only way to do that is to have all your docs ready before you start raising capital. So I'd recommend doing that. We kind of have almost standardized our docs. The PPMs are always different because they're specific to the deal. But like a lot of the operating agreements are very simple. And then your investors get familiar with that. Like you're not changing the terms every time. It's basically the same concept that they're signing into, and they appreciate that. So we like to do it electronically. It's very easy. It goes out through Juniper Square, but it's kind of like a DocuSign thing. They can sign up electronically, and then we wire it in, and boom, we're ready to go. We got the money. So that is how to raise capital. And one of the things I also wanted to share with you, when you're raising capital, you're always going to get people that are going to want to negotiate. Well, not always, but a lot of the times. So this is a great book, okay? Never Split the Difference. Chris Voss is the author. He used to be an FBI negotiator, and I actually think you should get the book and you should get the audio edition. Listen to it, read it. It's just amazing for negotiation, not necessarily negotiating with your investors, but just negotiating in business, negotiating in real life. It's awesome. And I keep it, refer back to it a lot. It's definitely been a very useful book. And, if you're dealing with a private equity firm, they're trying to negotiate the structure, negotiate certain deal points. There's some really good actionable takeaways. So highly recommend that. got like 60 people in here, and I think it's time for a little Q&A action. I'm gonna hit I'm gonna hit some of the Q&As in the chat really quickly, I think, and then or maybe I'll do like a little chat, a little live one. If you can, turn your video on because it makes it more fun. What are some of the best places to meet with potential investors, and what would your cold approach be? LinkedIn is a gold mine, okay? Go on LinkedIn, find people on LinkedIn, connect with people on LinkedIn, but you should also comment on stuff that they're posting and be an engaged person on LinkedIn so people kind of see your name kind of constantly popping up. I was at there's this guy Brent Beshore who has a really cool business where they invest in other people's businesses, and he hosts this conference, and they had this investor on there who's a young guy. I think his name's Ali, and he talked about how he like raised all this institutional capital and got all this deal flow by basically stalking people on LinkedIn. It was pretty fascinating. So LinkedIn is definitely a good place, but another good place is just out and about with your friends, learn about their families. Maybe you used to work with someone. It's hard, man. Like that's what I do. You just got to always be talking about what you do, and you never know who might be interested in looking to deploy some capital. But you also need to be careful about letting bad investors into your deal. And if someone's an asshole in the kind of dating phase of your investing relationship with them, it's not going to be worth having them in a deal because they're going to be even more of a jerk. And I remember it was the week of my wedding, and I think I was doing that first deal. And there was a group of investors that were going to invest like literally like $3 or $4 million. Like they almost would have covered me so I wouldn't have had to go to the private equity firm, but the private equity firm was amazing. But it was a big opportunity. And they were a bunch of like random guys that were friends, like teamed up in a pack. And they were asking for all these special rights and special treatments and a special deal. And sure, if someone's going to come in with a hugely disproportionate piece of capital, you can cut them a special deal potentially through what's called a side letter. But like a lot of what they were asking were unreasonable. And they like started like wanting to not like seek personal guarantees from me, but like really shift all the risk of the investment to me and not take any risks themselves. And like everyone's a big boy here. If you're making an investment, it's a very risky thing. A lot can go wrong. And I wasn't really willing to do it. So it was like 2 days before my wedding. And I was like, sorry guys, like thanks for like wasting all this legal expense and sending me all this crap, but I'm just not going to do it. And I walked away. And it was awesome. Some of the guys actually invested individually and they made a ton of money, which was cool because it felt good at the time, but so that's it. Let's go to someone not in the chat, but there's a lot of people, there's multiple pages. Raise your hand if you got a question. And come on video unless you're like driving, because then you'll come to the top and I'll see you. Does anyone have a question? Elizabeth.
Okay, thank you so much for this, first of all. My question
Where are you
is,
from?
I'm from Richmond, Virginia.
Cool.
So I'm an interior designer and I do a lot of hospitality projects, and also getting my MBA, so kind of interested in this world. So my question is a little more about the order of operations. If you're showing like renderings in your project, have you already hired your architects and designers before you're raising capital, or like, can you speak to that side of the process a little bit? Because you have to have some idea to sell them on, right? But it takes like you're investing in that design work too. So I don't know if you have like a separate fund for that, or I don't know if you can speak to that process.
Yeah, this is an excellent question. There's no right answer, but I'll give you a couple different scenarios. And by the way, speaking of great designers, we have Nate from Rios on here. We did a project together, the One Hotel West Hollywood. It is so badass. The reason it's amazing is because of all the landscaping, and Nate was the one that created really all of the exterior transformation. So Nate from Rios is someone to look up. But there's a couple ways to do this. If you really don't have any like capital and you need some startup capital, one idea might be to go to someone that you've been speaking with and say, hey, I'll let you come into the deal like unpromoted, just kind of straight up with me, or maybe I'll share some economics, I'll share some upside with you, but I need you to kind of pre-fund some costs. Maybe it's some pre-development costs, maybe it's some design work. When we're doing a preferred equity investment, we like coming in when all that's done and like the common equity or the sponsor took all the risk. But if I'm the sponsor and I'm doing the deal, what I would do is probably let a few investors in, maybe for like some of the pre-development work, which would be everything you're talking about. And then once we have it and we know we can build it, then bring in the majority investors. I've done it both ways though. And we've brought investors in where, it was maybe 60% baked and we were buying the land and then we had to go through some more entitlements or some more changes and some more budgeting. You could do it in a variety of ways. It's just important that you're upfront with your investors what stage you are in so that they can evaluate the risk. And it would be very reasonable to like treat investors differently that have taken different levels of risk in your project. So for example, if you have like 5 investors come in to buy the land and, get all the approvals and do all the designs or buy the building and figure out how you're going to renovate it and convert it into like this amazing idea that you have. And then you have, 20 investors that are going to come in when you're ready to execute, you're ready to get your bank loan, all that kind of stuff. You might have a different like structure. Those might be like Class A investors. They are kind of entitled to these economics. And then these Class B investors are entitled to that. And that's like totally normal, totally reasonable. And everyone would be able to understand the, differences. So hopefully that was helpful.
No, that is helpful. Thank you so much. I'm very much in the design side, so I wonder about like when that happens on the owner side. So thank you.
Yeah. And one of the other things that I would recommend to everybody is never go into, try and avoid at all costs starting a project with a contractor when you don't have fully designed plans and specs from your interior designer, because in my experience, particularly in hotels, that's an area where you always go over budget if you just have a bunch of allowances and the contractor is not Elizabeth and he doesn't know what Elizabeth's like great taste is, and he's just going to assume like crappy Home Depot shit, even though he'll tell you, oh yeah, I assumed what you guys put in those other hotels. Like, no, he didn't. Make sure you have all those stuff
Any
done.
samples in and like getting substitutions approved, and yeah.
You got it. 100%. Mitigate it. Great question. Christian, what's up?
Quick question on like your thoughts around potential capital structure and like ideal investor profile. So originally from the Caribbean, a lot of experience in the private credit and real estate private equity space. I think there's a really good opportunity for acquiring small key count value add hotel opportunities in the Caribbean, talking about 25 to maybe 60 keys. Ideally, from retiring mom and pops. It's a region I know really well and have a lot of relationships. But curious, given the small key counts and, in small islands in the Caribbean, what type of investor profile do you see potentially being a good fit given, if the deal returns pencil out appropriately?
Okay, so let me just talk about your strategy first. One, personally, I am very bullish on smaller hotels. Now, there's a lot of risk. There's a lot of challenges associated with them because you lack some economies of scale. But I think the hotels that I want to stay at, that probably a lot of you want to stay at, are very unique, very interesting. Mahavir on the call has like a really small hotel, one of his properties. So you can make money on them. And I think the uniqueness of them is going to drive tremendous value. So I like what you're talking about. I like what you're thinking about. In terms of investors for those types of deals, I think locals would be a good one. And like frequent visitors or people that aren't from the Caribbean, but that are like from the mainland that like to vacation in the Caribbean, that have a house there or that go there. That would be like a huge opportunity. Like if you have a guy that like loves walking around and like Tommy Bahama shit and like with the big cigar, walk around in flip flops and sold his company and is just floating around a Viking, like hit him up. Like, go to the local bars, go to the local hotels. And those are the kind of people that I think would understand the opportunity because they go there. I think people that don't go there would be more concerned and have more likelihood to say no and just be a lot of hesitation around the risk and execution and all that kind of stuff. The cool thing about investing in hotels, I mean, other real estate offers this as well, but it's very different from investing in a company because you can physically go to the asset. You can physically go see it. A hotel is amazing because you could actually go inside of it. You can touch it. You can feel it. You could see it. You could stay there. Apartments, maybe some extent too. It's good if you have people that are already there. Coleman, let's go to you.
Going a little bit smaller than what Christian was talking about, I'm looking at building something in West Texas, right outside Big Bend National Park. I have a small little thing right now over there, but I saw in your presentation you have like comps and one slide of like the comparisons or comparables. What if you don't really have a lot of that? Because I'm talking to several appraisers about even potentially selling what I have just to raise capital or getting some, investors involved to work on a bigger project. But even the appraisers are like, I hate to give you an appraisal because there's really not much out here to compare it with, despite the gross rev that I have to show. So that's where I'm kind of like trying to find how to overcome that.
It's definitely hard, but you can start to go outside of your local market and go into other markets that have similar dynamics to you. It doesn't have to be in West Texas. It could be in another area that has a similar setup, like that's, leisure oriented, that kind of like looks similar, that has similar demand generators. That would be good. Another thing that I would do is find like niche brokers, like there are niche like hotel brokers that just sell like these little mom and pop-ish hotels in certain markets. Try and find those people and get their opinion on value. I mean, the other thing you could do is you can underwrite to a cap rate where, that might be hard, but you can do that to key into a value as well. But it's important to figure out that you're going like, you can avoid showing comps if you conservatively show how you're getting to justify your valuation and the money that you're spending. So if you're showing these kind of returns because it can produce this kind of income, but there's not a lot of comps, well, like that in and of itself is good diligence, good evidence of your value. But you have to tie your cost with your returns. You know what I'm saying? And you can do that on an unlevered basis or a levered basis. But, that's one way to do it. Like if you're coming up with a completely new idea and there's like nothing, if you think about like Neil at AutoCamp, like there wasn't a lot of like Airstream trailer concepts that he could go around to really value, but he was valuing the business opportunity. And I think if you more so value the business opportunity and put a slightly lesser emphasis on the real estate, that might help you justify some of your costs. And then you can also just like zoom out for a second and be like, wait a second, like I'm into this thing for $5 million a key. Hold on. There's like 3 hotels in the country that are at $5 million a key. So maybe I'm too crazy. There's got to be things that you can kind of double check against, but I would probably focus on the business valuation more and then kind of like add something for the real estate.
Okay, well, with the business valuation,
you're valuing the income relative to your cost. Like what's your return on cost?
and because it feels like I agree with you there, but it feels like everyone or appraisers I speak to, they're like, oh, it's more about the land versus the business, but it doesn't seem like they're in the
Well,
business.
yeah, because they're like a real estate appraiser. They're, that they're not the right appraiser. So one thing you could do is go to a hotel appraiser like HVS, JLL, Colliers will do it, and have them provide a valuation.
Awesome.
Yeah, definitely do that. Or another hotel broker. They always do that as part of their services. Let's just go to someone in the comments. Do you ever do deals in new markets without a local sponsor to partner with? This is from Blake. If yes, how do you mitigate the issues of not being there in person? This is a great question because there's no right answer, but you have people that are very like true to the camp that they're in. So you have some people that say you can't be a developer in a place where you don't have boots on the ground. And there are some people that say you can. And there frankly are examples of amazing developers that have done both. But the reality is the amazing developers that have done both, they kind of transport boots on the ground. So most likely they've put someone on their team or they've hired someone there local to execute for them. It's something that we are always concerned with. We are always going to underwrite more conservatively if we don't have maybe a presence there. But yeah, of course, we look at deals where we are not living there or we don't have an office there. But you have to really, really heavily factor in, your commute time and your ability to execute and how that's going to go. For example, the deal that I worked on with Nate was in West Hollywood. Like our team is based in Fort Lauderdale. We were flying to California like 2 or 3 times a month, which was a lot, but we were able to execute because we had a great team. We had great boots on the ground partners, like contractor types that we could hire and work with. But there was times when we had to be there for a week and you just have to do it. There's no way around it. And that was just to get it open. But then, there's a whole operating team that has to be there to manage it and make sure it's going right. So it's definitely possible, but you have to be really on your accountability and really have systems and SOPs and processes in place to make sure that you don't miss something. And there's always going to be a fear probably that you have that it's like, wait a second, I'm the person from out of town coming in. Why didn't all these local guys buy it? And I think you need to ask yourself that question. Doesn't mean that you're not going to be successful. Maybe they just aren't creative enough to figure it out, but you need to ask yourself, like, I'm sure there's local people here that probably saw this deal. Why aren't they buying it? Except maybe, your best friend's grandma died and she owned this inn and he just brought it to you first. So no one even knew about it. But if it's just like a broker deal out there, you got to wonder if you're the dumb money or if you just have the best idea.
We're in the hospitality hotel business. Question I had, whenever you started your first raising, what made you decide from going from just traditional common equity to pref?
Well, we still do common equity today. So what made me go to pref was actually COVID. And it was also the first time that we started investing in other people's deals where we're not managing the hotel. So we're in the hotel business. And it was a moment in time where we saw an amazing opportunity to leverage our network and our relationships, raise capital with a strategy that I learned from Dean Adler of Looper Adler. He taught me, and then we kind of honed a really great strategy together that was very helpful to people and that filled a need. Now that need is 10 times greater because during COVID, people needed money because like their hotel closed or demand dropped to zero. Now people might need some kind of bridge equity or some extra equity because their lender needs a pay down. Their interest rate has doubled. They need a loan extension. They haven't renovated in 5 years because they survived COVID and now they can renovate their hotel, but they don't want to capital call their investors or they can't capital call their investors. Maybe you've tapped everyone in your network and you just can't raise enough money. So pref for us is a great way to invest. And if we're not going to be in the driver's seat, because this is our business, if we're not going to be in the driver's seat, then we want to be in a less risky position. Pref enables us to be in a less risky position, still use our skill set, still add value to the deal, but basically get an equity-like return for taking kind of like debt-like risk. So that's how we saw the opportunity. And now in the market where there's a lot of sellers holding on to much higher prices, pref equity is a great way to get deal done because we don't really have to like fight over the total valuation. I just need to be comfortable with my last dollar basis and my entry point in the investment. So that's how we got into pref. If you need pref, if anyone needs pref, and it's like kind of like, you have a real deal and like you're real, like we'll look at it, reach out.
I think on Elizabeth's point, when it comes to structuring pre-development and development separately, could you go a little deeper into that? Like, have you done it? How do you structure that?
Yes. So
Like,
I think
especially with hotels, let's say, right? Permitting takes forever. I mean, everything from acquisition to permitting, could often take a while. All the, and it could often be, different type of financing or investors, right? So, I mean, you also have like, whether
yeah,
it's a
so
multi-entity approach or like,
the early part is a lot less risky. So those investors would demand a higher return. So you can construct two different deals. You can basically have kind of a pre-development deal, and then you can have new investors that come in at a later point, and you can actually like mark up the value of the land to compensate them for the risk. So that's one way to do it, because now that there's entitlements, you can build something, the land should be worth more money. So the early investors kind of get an increase in their investment that they can roll into the deal, and the newer investors pay for that. So that's one way to do it. Another way to do it is to let the early investors have like a different structure, like maybe they don't pay a promote, and then they can invest in the deal. So there's a variety of ways to do it, but I think you need to, if you're going to mark up the land and kind of sell it to a secondary investor, you need to make sure, and you're going to be the sponsor on both sides of that transaction, you need to make sure that you leave a little bit of money on the table, because no secondary investor is going to like overpay you for that. So if anything, they're going to underpay you. And, maybe you can mark it up like 30% or 40%, or, something like that. But you want it to be less than what an arm's length transaction would be, I think is the best way to do it.
I mean, it could really be transferred at true value, right? Does it need, right? It could be like a true.
Yeah, you could. Yeah, if you transfer it at cost, but then you have to compensate the other investors for taking the early risk.
Like a true current value, right? You're compensating. I mean, roughly true value.
Yeah,
right?
In my experience, if you're compensating it at true value, like what it would be at an arm's length transaction, I think your subsequent investors are always going to think that that's potentially a little fishy. They're going to want to have a little bit of a wider safety margin, in my experience. If you can do it, do it. But I would say it should always, if you make it a little bit of a discount to what the real fair value would be, I think you'll have more success.
And to avoid issues with purchase tax, is it better? Like I was thinking structuring as like acquisitions co, one buys property one co, right? Where
yeah, I wouldn't even do that. You could just keep the same company and just kind of mark up the value within that same entity. So you're not doing a real estate transaction. You're avoiding any transfer tax.
Right. No, but if instead of rolling in the same entity, right? If I want to bring in a new set of investors, right? Rolling in the existing property, having acquisitions, property one co, buying property one. So meaning transferring the shares of the property company versus acquisition.
Yep, you could definitely do that. 100%. Yeah, so you're not doing a real estate transaction. You're buying the LLC or moving the LLC into that entity. 100% do that. All right, Boris has a question that he wants to set up a PE hospitality fund in Bulgaria. That's pretty cool. In the next 12 to 16 months. His company has a great track record as a hotel developer. We signed 2 HMAs with Nobu in Bulgaria last year for a large investor. My question is, where should I start building the team and figuring out the fund structure and investment opportunities? It might be easier just to start off with one deal and then do another deal and then do another deal. And then if that works out, then maybe you do go to a fund. I wouldn't just jump right into a fund. I think it's a lot more difficult. That's been my personal experience. Even though it sounds like you have a great track record, find the deal. And then I think you'll find the capital if the deals are that great. And one thing that I've always done is had a very lean team mentality. I don't want to have this massive team to like create all this overhead for me and feel this huge obligation to support people and their families if I haven't really tested out the business plan. So I like running with a lean team. There's different ways that you could scale up and still run lean. Like we have outsourced certain parts of our business to phenomenal people that we wouldn't be able to get if we hired them on our own because of economies of scale. So, that's definitely something that we've taken advantage of and that I'd recommend to everyone starting out. Everyone with a PE fund or starting a real estate company in New York likes to hire 10 different people because that's what they did at Blackstone. Well, like you don't have the balance sheet of Blackstone. So if you run into rocky times, or you're going to feel forced to do deals that might not be the best deals because you need to support this whole team. So if you have a lean team, you don't have this added pressure to generate enough fee income or deal income in order to carry them. So I would look at a bunch of ways to do things in a more entrepreneurial way, just like you have been doing. And then fund structures, and I wouldn't reinvent the wheel. I would keep things simple. There's no need to reinvent the wheel or come up with some creative new way to structure an investment or do a waterfall. No need. Oh, this is a cool question from Jasmine. Building a new private members club. How would institutional capital view this? Or is this more of a family office, high net worth play? A friend of mine owns the hottest members club in LA. And from my experience, it's more of a family office, high net worth play based on how he started. Eventually it became so popular, I think it became a little bit institutional. So he was able to do that. But it's definitely easier family offices, high net worth, because those are actually going to be your customers probably. And they'll understand it more because they'll go and they'll be a guest. But adding a member club has become very popular to a lot of hospitality and real estate ventures because a lot of those membership dues and fees cover a lot of fixed costs. You just have to be good at selling memberships and attracting a lot of people and making sure it's viable. I like that concept as an add-on to an already thriving real estate business. So if you already have a great hotel, maybe you can dedicate a floor as like a members club. I think if you do a members club first and then try and have a very small hotel and a restaurant that's just for members, you have a very high cost structure that might be hard to execute.
So I'm based out of Chattanooga. I was wanting to ask you a question about the first deal you talked about. It was a co-GP structure. What do you think were the benefits to that? And then my second question is kind of following up on the purpose of this call as far as having conversations with getting people to invest in your deal. What do you think were the amount of conversations you had to have with them to get them?
Millions. You get told no all day long. You're going to get told no. I was on the phone call with this guy. Maybe he's on the call. He's a really smart guy. He started a new kind of real estate vertical, and I've never heard of this. I think he had a great family network and maybe a great family relationship, and he had a good track record. But he's like, I met with 80 investors and 78 told me yes and investing in the deal. Let me tell you, that's never been my experience. Never. And that's an amazing hit rate. Do not expect that. It didn't happen for me, but keep going back at people. Keep going back at people. Just because they said no on the first deal doesn't mean they're going to say no on the second deal. The benefits of a co-GP structure was getting the deal done. It's quite simple. I wouldn't have been able to get the deal done if I didn't have the humility to share in some of the economics, some of the profit sharing, the promote with my partner in the deal. If I was greedy and just said, no, I'm going to find an investor where I'm going to keep all the upside, I might have not found the investor and I might not build my company. I could have gone through door number 2 and been in a totally different place and not here in front of you today. So it expanded my world and expanded the opportunity and allowed me to be a part of a great deal. But that's a good question, actually, because we had someone today asking us if they could co-GP on this pref equity deal in Savannah. I'm like, well, we don't need a co-GP on the deal because we're going to capitalize the deal on our own. If you want to put in money, then put in money. Maybe if you put in a lot of money, I'll cut you a special deal. But we don't need any help executing the opportunity. We source this opportunity, and the deal is also pretty small to begin with. So I need to make sure that I'm feeding everyone on my side. There's not enough to go around on this deal. So if you want to get in on the deal, let's do it. I'll cut you a special deal because maybe we can do other deals in the future. But I was just honest. I'm like, it's just not, the deal's not big enough for 2 people. And there's also not a lot of strategic value I think you're bringing to the table, other than being a nice person and being good capital on this specific deal. It doesn't mean you don't bring strategic value to another deal, which is certainly right. In the deals that we've had great co-GP relationships with, each partner brought very distinct strategic value and competitive advantages to the deal. So that's key.
I think that was my main question with like finding a GP that has strategic value to add, especially for someone doing their first deal. And what you said about having a bunch of conversations with different investors and having to hear no a lot, I think that's definitely accurate depiction.
Yeah, you're going to go to a lot of coffees, man.
But what would you say, like from the conversations that you hear yes from to getting to close? Like, how would you say that pipeline is, like from following up and things like that with the people who are interested in the deal?
Pretty good. Typically, if someone spends time with me on the phone, then they're going to invest in the deal. I would say 8 out of 10 people that I talk to, like about the deal, will invest in the deal. It might even be 9 out of 10, but the reason for that is very much skewed towards the fact that I already sent them that video recording. So they already know about the deal. So they're already kind of interested in the deal. And that helps weed out people that might not really be looking at the opportunity or might not have understood the opportunity, but had no interest in investing. So then you don't have to waste time talking to them. On the flip side, I think you can convert people a lot of times. And I do get on the phone with people where they're like, I'm really not interested in investing in in a hotel right now. But I'm like, yeah, but this isn't like just a hotel. It's a preferred equity investment in a hotel. So it's different. Oh, okay. So you can convert people that also say no. But I think having the video go out first increases your chances.
More so that education that you've already done before you get in front of them.
They already know about the deal. So that way, when you're going there, like you both know what you're walking into.
Hi, Jake. Thank you for doing this, by the way. Really appreciate it. Just wanted to know, in that investor, relationship, raising the capital, at what point do you, if any, do you distribute an NDA? Is that in the PPM? I haven't seen a PPM yet, so.
That's a good question. I don't distribute really NDAs because the time that we're raising capital, like we already have the deal. There's certainly a reason why you might want to do that. A high net worth person is typically not going to steal your deal. If you're dealing with like a big institution, a big group, and they could really be a competitor, or they could share your information or use it on some other deal, it might make sense to do an NDA. If you didn't have the thing tied up, I would 100% recommend an NDA. And by the way, you know how to get an NDA? Go on ChatGPT and have them make your NDA for you.
Yeah. It's just the site I'm looking at has 3 different owners, and so it's like just trying to break it up and trying to, if I can't get all 3 at the same time, which is really hard to do, kind of still want to move the needle forward with some investors to kind of say, hey, we're working towards something here, jump on board, or even tell the seller, look, we're a real deal, we have some money behind this, XYZ. So thank you for that.
100%. But we sign NDAs all the time. It just depends on the phase of the deal and the approach and the strategy, but it seems like you're thinking about it the right way.
So on the subscription process, I mean, sometimes it can be daunting. It can take time. Any best practices in your investor software that you use to make it seamless or easy on the first deal, and then kind of in the same context for a repeat investor, what is their subscription process like?
The same every time, but they have to resubscribe for a deal each time, but definitely do it with a digital platform. So whether it's Juniper Square or you just use Dropbox or DocuSign or something like that, do it that way and include all of the key documents in that subscription package. So they have everything. So they can never be like, oh, I didn't get the PPM or I didn't get the OM and it's important to date all of those documents so you don't have multiple OMs flying around. If you do, you want to have them all dated and you want the latest version in the subscription docs. We have found the best way to do it is to boil it down to really the most salient questions that you need for the subscription, and don't waste time on a bunch of lawyerly crap that maybe you don't need. This doesn't mean that you don't have the legalese, but what it does mean is just make sure that you're getting the most important details from them in the subscription agreement, and you don't ask them for all this extra crap that's going to be annoying for them to get. So like oftentimes we do distributions with like a wire or ACH, so we'll ask for their wire and ACH information. But like maybe you don't need to put that in the subscription doc, and you could send a subsequent form out to your investors that's secure, and you could say, hey, give us your information here, like after the process, so they don't have to like look that up. I always like people to be able to do it on their phone or on like an iPad and not kill themselves. And the other thing that we've found that's very valuable is if you can pre-fill information for them, just go ahead and do that.
That was kind of my question, especially on the second deal. So we're using Juniper Square, but on the second one, do they go back and fill out the same accredited investor questionnaire as well? So just all over again?
Yep, because it's a new entity. Yeah, it's a new entity. So you have to verify them for, as far as I know, you might be able to find other research. But yeah, the accredited stuff is annoying because like, they should send you some documents. There are services online that will verify accredited investors for you, which you can check out. We do all the same stuff, man. It's just, but now we have, I don't have to do it. Like I have an IR person in my office to do it. So that's nice. But when I first did it, I was literally doing it all myself, like making sure every subscription is there, checking everyone, and doing all the deal crap. Like it sucked, but you got to do it. You got to grind it out. Everyone does it. Oh, this is a good question from Jose. Is the P&L you're showing based on your own assumptions or on the operator's portfolio pro forma? And how do you typically challenge or validate key assumptions like OTA costs, employee costs, and management fees? So what I showed was our pro forma, which was much more conservative than the operator's pro forma and the sponsor's pro forma. So I took their numbers down to feel more comfortable and add a wider safety margin. And how do we validate assumptions? By talking with other operators in the market, where I can ask them like what their margins are, by looking at other P&Ls, like maybe a hotel was for sale and we save their information and we could see what another hotel was doing. I could compare them against other hotels in my portfolio. That is what we do. And then some things are just like standard things, like credit card commissions are pretty much like, I know what those are. Management fees, they're typically like 3 to 4%. So there's like a few things that but like in a new market, like labor and wages might be, it's going to be different in Savannah than it is in Los Angeles. Rose is asking, share a story of a very unexpected investor who literally just came out of nowhere. You were not expecting this person to invest and they invested with you, or a cool investor story where you were raising capital and you shocked yourself in how this person or entity decided to come into your deal. The first one that jumps to mind is we had just this guy is great. He's so smart and just a nice guy. Like some investors are not nice. This guy is just super nice. And this was maybe like the second deal I did. Some things didn't go to plan. Things have taken longer. We've had some issues. We still own the hotel. It's going to have a very strong year. We're still working through it. But he invested in that second deal, and then I don't think he invested in any other deals. And he, comes into town every so often, always asks to meet once in a while. Maybe this is once a year, once every other year. And I met with him this year in our office. We were talking about the other deal. Was very direct and honest about this other hotel that he's invested in. And he, like our other investors, got this most recent investment. And he committed, and another person from his team committed. And it was just great. I mean, it was unexpected because I was thinking like, all right, maybe he wouldn't invest because he wants to see how that one performs. But the key to investing, in my opinion, is betting on the jockey. And you're not always going to get the deal right, but you're going to get the sponsor right a lot of the times. And what we're looking for in investors are long-term relationships. And I'm telling you, like, not every deal that we do is going to be a home run. Not every deal that we do is going to be smooth sailing. There are going to be problems. Like some deals, like maybe you get your money back. Some deals, like maybe you get your money back plus like a little bit more. Some deals, maybe it's a home run. But what I want to convey as a sponsor is that we're going to do everything with integrity and be respectful and treat our capital just like your capital. And this person obviously saw that. So that was really cool. And wasn't expecting him to invest, and didn't really ask him. And he did. So that was awesome. Nice surprise, and very humbled by the confidence. Have you ever, this is a cool one. Have you ever tied up a deal you weren't able to capitalize? If so, how do you manage that with the broker and the seller? Yes. Oh, like so many stories. We had one deal where we had it capitalized, where it's like one of these co-GP things, okay? It was just a big deal. So I couldn't raise all the capital on my own, or I just didn't want all the stress and the pressure. So I brought another person. I think it was like $35 million of equity, and we were both maybe putting in 17 or something along those lines. So I think we were kind of going to split some of the economics, and maybe he was going to promote his investors however he wanted, and I was going to promote my investors however he wanted. And smartly, I created something called a deposit sharing agreement, because I wanted to make sure that if this guy didn't show up at the table, that he put up some of the deposit, the hard deposit that we had up with the seller. And some crazy thing happened. I can't really go into what happened with this guy, but he had all of his capital ready to go. And then the money was frozen. He couldn't invest it. And we couldn't really locate him. Eventually, my lawyers found him, and we determined that he wasn't going to be in the deal. And I went back to the seller. I told him this crazy thing. I'm like, literally, like the week we were going to close, we couldn't close. And they were very reasonable. They didn't try and take our deposit. We took the other guy's deposit because of the deposit sharing agreement, which was very helpful. And then we had to raise like all this capital in like 3 or 4 weeks. And because of relationships, I was able to get someone to come in on very short notice. We signed a deal that was like worse off for us, but we got the deal done. We made it work. So that was an example. Like, business is hard. Things do not always go as planned, but your relationships will surprise you. And it's sometimes better to get a deal done and leave some money on the table than not get a deal done, because you just don't know what's going to happen. So I'll probably leave it there. And this was a lot of fun. I hope you guys got value, and look forward to keeping in touch. Check out the podcast. Give me a little rate and review, and we'll continue to be friends online. And it was nice to see some familiar places here. Have an awesome weekend, awesome day, and go crush your deals. Hey everyone, it's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter at Jake Wurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of DoveHill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of DoveHill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.